Hi guys, welcome back to my YouTube channel. And this is Momboa, your future CFO. If you're returning, you guys will just hear some. If you're new here, welcome to my YouTube channel. This is the place to be if you want to learn something new, something that will change you, will give you some ideas on how to run your business, maybe to be a better accountant. If you're learning accounting to be a better student to pass your test. So welcome guys. And today what we're gonna be looking at, we're gonna be looking at break-even analysis. So what is break-even? I know you've heard about break-even point, a point of indifference, a point at which our total fixed costs equals our total operating income. It's a very important point. As an organization, you are able to make decisions. You are able to know at this point, we've covered all our fixed costs. And when I talk about fixed costs, we are talking about costs that have to be met no matter what. So we have rent to pay at the end of the month. The rent needs to be paid. We have salaries that we need to pay. Salaries have to be paid. So it's important as an organization to know your break-even point, and that way you're able to know how many units you need to sell for you to break even. Then any unit that you sell after you've broken even, you're making money for the organization. The contribution margin per unit, it's money that you're making for the organization. So guys, that is what we're gonna be looking at. And there's some assumptions that we will be using for the purpose of this video. The assumptions for break-even, that the unit selling cost is gonna remain the same. So our selling price will not like fluctuate, go up and down. It's gonna remain the same. The other assumption is per unit variable cost. So per unit variable cost is gonna remain the same. Yes, our total variable cost is gonna increase depending on the number of units that we're gonna be selling, but the per unit, the variable cost attached to a single unit, that is what I mean. Every single unit is gonna remain the same. The other assumption is the time value of money. We're gonna ignore time value of money. We know that $1 today is more valuable than $1 that you receive maybe like in 1 year's time. So those are some of the assumptions that we're gonna be looking at, guys. So stay with me all the way to the end, and I'm sure you're gonna learn something new. You're gonna learn how to calculate your margin of safety, how to, like if you're targeting a certain income, net profit, or maybe operating income, how do I calculate it? Maybe let's say, for example, after you've broken even, you're targeting an operating income of maybe like $20,000. How do I know how many units I need to sell for me to achieve that operating income? If I'm like targeting a net income of this much, and we know net income is the income after you've deducted all your expenses. You've deducted all your fixed costs, and you've also deducted your tax. So that is the income that remains, your income that we say that is the income for the organization. And that is what goes to our retained earning. So guys, stay with me. And without much ado, guys, let's now get started. So we're going to be looking at an example where we have our sales figure, our variable cost, our contribution margin. And our contribution margin is our sales minus our variable expenses. That is what gives us our contribution margin. We have our fixed costs, then now our operating income. So for us to calculate our break-even point, we need our contribution margin per unit, which we call the UCM. the unit contribution margin. So our selling price per unit is we've sold 10,000 units, and each unit we are selling at 40 per dollar. So the unit selling price is 40. So that is that is our selling price per unit. Then we have the variable cost. We've sold 10,000 units. The total variable cost is 100,000. So how much is our cost per unit? So we get our 100,000 divided by 10,000. That gives us the variable cost per unit is $10. So our contribution margin per unit, the unit contribution margin is selling price minus the variable cost. So that gives us 30. So 30 is our contribution margin per unit. So if we want to know our break-even point, this is how we calculate our break-even point, because we know fixed costs have to be covered no matter what. If we sell one unit, at the end of the month, we need to pay rent. If we sell like 5 units, at the end of the month, we need to pay salaries. We need to pay our staff. So it's important as an organization to know your point of indifference. So how do we calculate it? We take our fixed costs, divided by units contribution margin, fixed cost over the UCM. So like in our example that we're using, we have our fixed cost at $150,000. We've calculated our UCM down here. So our UCM is 30. So if we want to know how many units we need to sell for us to break even as an organization, we take our fixed costs divided by our UCM. So for this organization, it needs to sell 5,000 units to break even. So once we've sold 5,000 units, as an organization, we've covered all our fixed costs. So anything that we sell above 5,000 units, it's income to the organization. So that is how you calculate your break-even point using UCM. There's also another way you can calculate in terms of dollars. And for you to calculate in terms of dollars, we need to get a percentage of our UCM expresses as a percentage of the sales. So our sales is 100%. Our variable cost is it's 25%. So our contribution margin is 75% of our sales. So to get our UCM in terms of dollars, we get our fixed costs, which is $150,000. Then we divide by our UCM, the unit contribution margin, the percentage, sorry. So we get our 75%. So we get 150 divided by 75%. So as an organization, the dollar value in terms of sales, if we want to break even, we need to sell sales worth the, let me get this in terms of I need it to be somehow clear so you're able to tell exactly. This needs to be 0. So as an organization, you need to sell $200,000 worth of inventory to break even. So that is how you calculate your break-even point in terms of unit contribution margin and also the contribution margin ratio. That is using the percentage. So guys, next I'm gonna show you how to calculate your margin of safety. So margin of safety, we've budgeted as an organization. This is the number of sales we're gonna be selling. Like, let's say for example, in these, the example that we're using, Our budget is we're gonna be selling 10,000 units, which is what we've sold. So a margin of safety is any sales above your break-even point. So for example, like here, we've sold 10,000 units, and our break-even units is, the break-even units is 5,000. So any sales above 5,000 is our margin of safety. So let's say, for example, here, our budget was $10,000. The break-even point is 5,000 units. So anything above 10,000 units is your margin of safety, which is $5,000. In terms of the dollar value, our total sales are 400,000, which is what we have here. We know as an organization, we are breaking the breaking point in terms of the sales, the dollar value is 200,000. So our margin of safety is anything that we've sold above the break-even point. So that is how you calculate your margin of safety, guys. Very first, I want to show you how to calculate your break-even using your target income. Like I'm targeting, let's say for example here, I'm targeting an operating income of 200,000. So you get your fixed costs, you add to your target income, divide by UCM, unit contribution margin. So let me show you how we do it here. We get our fixed costs. Our fixed costs are $150,000. We're targeting as an organization. We want to make, let's say, for example, 180 operating income. So 180 divide by the unit contribution margin, which is what we have here, 30. So for you to achieve that target income, in terms of units, you need to sell 11,000 units. You need to sell 11,000 units if you want to achieve an operating income. Okay, just a minute. I want to see this in terms of dollars with commas, accounting, the format. Okay, if you want to make 180,000 operating income, you need to sell 11,000 units. Another way of calculating your target income, we can say we are targeting, as an organization, we are targeting a net income of this. For example, here we are targeting a net income. This is income after tax of 180,000. So we've covered our fixed expenses, then now we've paid tax. So if I need to have a target net income, how do I calculate it? You take your fixed cost, your target net income, and this is income after tax. So we take 1 minus the tax rate. And for the purpose of this video, let's assume the tax rate is 40%. Divided by unit contribution margin. So you get your 180, which is what you're targeting as your net income. Divide by 1 minus the tax rate. Our tax rate, we've said we assume have 40%. So we're dividing this by 1 minus 0.4. Then we had our fixed cost of 150,000 divided by the UCM. So you're able to know how many units you need to sell to achieve your target net income. So guys, that is how you work out to get your margin of safety, to get also your target operating income. This is income before tax. And also how to calculate if you're targeting a certain net income in terms of units. If you want to get the same in terms of dollar amount, instead of using UCM, you use what we call the UCR. the unit contribution margin rate, which is 75%. It's basically the same thing, guys. You only need to change this from 30 to 75%. Then you're able to get the figure. So guys, that is what I had for you today in terms of calculating your break-even point. It's a very important point for any business. We in business to make money, so you need to know at which point you are in difference. You've covered all your fixed costs. It's really a very important point. And from our leverage calculation, the operating leverage, we've said these are costs that need to be covered no matter what. So these are costs that needs to be covered by the organization. And the best thing that you can do as an organization is look for ways how you can cut these costs. Look for ways how you can reduce your, maybe your admin expenses, your rent expenses. Are we operating maybe units that are making losses? We need to analyze and see, do we still need to continue keeping these offices? So it's important to analyze and check how you can cut costs on the different fixed costs, because the lower the fixed cost, the more money you're making as an organization. So basically, guys, that is what I had for you in this video. Thank you for staying with me all the way to the end. You guys are just awesome. You're just the best. Thank you. Stay tuned for more video that I'm posting each and every day. So don't forget, guys, hit the button, subscribe to my YouTube channel. Make sure you don't miss any future videos. Thank you, guys, and be blessed.